Welcome back. The Reserve Bank left interest rates unchanged and gave no hint at all about the timing of a rate cut. The fact that it has upped the growth forecast may mean that rate cut is not needed because growth is strong. More important, however, Reserve Bank said in the press conference that it will release its view of the neutral rate in the next bulletin, RBI bulletin. Now, what's the neutral rate? It is the ideal difference between the nominal interest rate and inflation. With the current repo rate, that is the nominal rate, at 6.5% and CPI forecast for this year at 4.5%, the real rate difference is 200 basis points. But if the RBI thinks that the neutral rate is 150 basis points, then the market will expect a rate cut sooner. So the next RBI bulletin actually becomes more important than even the MPC. For these and other issues, I'm joined by Santanu Sengupta, Chief India Economist at Goldman Sachs. Shantanu, good morning, and thank you very much for joining us. I just had to give the preface because neutral rate is not something we, speak about very often. But what's your best guess of the cut? Are you on mute?
Sorry. Thanks, Latha. So we think that the neutral, in our view, is somewhere around 6% for India. And therefore, the real neutral is about 150 basis points. This is higher than what you've seen in the past in the region of 80 to 100. And therefore, we think that, you can still have the quantum of cuts in India will be determined by the neutral rate, and which we think still is going to be only 50 basis points. The timing of the rate cut by the RBI still remains a difficult question. As one, growth remains strong, and along with sticky trajectory of food inflation might mean that some of the RBI MPC members may be reluctant to pivot immediately. But our call still remains that you go in Q4 of calendar year this year. It's a toss-up between the October or the December meeting, in our view. We think it's slightly more leaning towards the December meeting if you see that food inflation is sort of contained by then, and core inflation sequential momentum is also not as strong in the second half as you head into the end of the year.
Okay. I'll come back to the rates position and the fiscal connection in just a minute. But the other big takeaway from Reserve Bank was the increase in the GDP forecast for the current year, or GDP estimate for the current year. You already upped it by 20 basis points, your forecast, after what you heard from the Reserve Bank, or because the government is not what we thought it would be on 31st when you were making your forecast. It's a less, it's a lesser majority than we thought. Do you want to tinker your growth forecast either ways, or is there an upward or downward risk to it?
So we are at 6.8% growth for the fiscal year 25. The calendar year is slightly higher, and basically the fiscal year is low because of the very high number that you got in the previous quarter. Look, for the cyclical growth view, we think the risks are fairly balanced. So I don't really think there's a major upside risk to our growth forecast, especially given the fact that we are still baking in the fiscal consolidation. Even after the election outcome, we think that we are still going to go towards 5.1% of GDP, or they'll try to slightly better that, maybe at 5% of GDP in terms of the fiscal consolidation. And then if monetary policy also remains tight, in our view, at least until October or December of this year, then and monetary policy works with lags, then you don't really have a cyclical fillip coming from the policy side to raise growth forecasts. Now, would the private sector capex cycle be markedly stronger than what we are anticipating now, which could raise our growth forecast? That could be an upside risk. But otherwise, I would not really, I would think that the risks are fairly balanced around our forecast right now.
Okay, but let me just push you a little bit on that. Some have read the election verdict as an indication that several pockets are dissatisfied, that the K-shaped recovery has hurt large segments, which is why you saw in Uttar Pradesh, Rajasthan, Haryana, the ruling party performing badly. So would you expect, say, higher MSP or some other kind of largesse, which may disturb the fiscal numbers, but which may be positive for growth as well?
So, Lata, again, from the macro perspective, the aggregate fiscal impulse is what matters. And within that, what is the mix of consumption versus, let's say, investment, right? So we think that the aggregate fiscal consolidation towards 5 or 5.1% of GDP remains intact, especially now that you have the buffer of about 30 basis points incremental from the incremental dividend from the RBI. Now, could there be a switch towards more welfare spending as you head into the second half of the year? That's possible, given some of the election, how you interpret the election outcomes. But that necessarily would not be incrementally positive for growth, because the aggregate fiscal impulse still for us, would remain intact, because you will have to shave from somewhere else to provide the fillip here. I think the upside risk again is coming from a capex cycle if it really picks up much faster than what we are anticipating.
Okay. Well, I would still wait and watch for whether there are large state packages. After all, in the portfolio, we still don't know the portfolio, but it doesn't look like the plum portfolios are going to the allies, in which case they have probably been promised or are expecting state packages. But anyway, that discussion for another day. We would know it shortly. I wanted to get your view as well on, the US non-farm payrolls, indicating that, the Fed perhaps is not cutting anytime soon. The yields have risen. I don't know if you are the point person to tell us what is the Goldman Sachs view on yields in India. Will it be continue to be between 6.95 and 7.1? What is your yield expectation average for the year? And rupee, more importantly.
Yeah, so we do not put out forecasts on the 10-year benchmark bond in India, but what we like, because of our view on monetary policy, and we are baking in rate cuts in the later half of this year, is we like the short end of the curve. So we have a standing recommendation on a long 2-year IGB. And the main reason is because the curve, if you see in India, is now really flat. And if you think that the neutral rate in India is around 6%, so the RBI can ease up to about 50 basis points, which is our view, then the short end at some point of time is what we think will rally more than duration, and therefore we like to be in the short end. On the rupee, even with the election outcome, etc., we don't think that with the reduced majority, the macro stability which India has earned in a hard way over the last 5 or 7 years, that is getting, that is going away. We still think that the current account deficit will be narrow. We still think that the fiscal consolidation will be maintained, and inflation will remain within the target band of the RBI. And therefore, we continue to like the rupee as a low-vol carry currency. We have a short euro and our trade recommendation.
Okay, got that. So rupee appreciation, or rupee at least not depreciating much. Shantanu, you had an excellent report on India's savings and investment. I can't do much justice to it. But from what you are saying about rising financialization of savings and more money going to insurance, the trend you said 15% CAGR over the last few years, are you suggesting that there is a longer-term rally in the bond market, one, because, interest rates are likely to remain subdued, fisc is likely to remain subdued, and secondly, are you seeing the rise of a corporate bond market in India for the longer term?
Yeah, so look, we think there are two implications of this. Broadly three. One is that the capex cycle domestically should get funded with the savings that you're generating. And that reflection is in the current account. But 2 and 3 are quite important. Second point is that you're having duration savings in India through pension and insurance. And that is anchoring the long end of the yield curve. So if you see from the 10-year point all the way up to 40, it's a pretty anchored and flat yield curve. But that the government is also going to consolidate at the same time over the next several years, which means that you're having the savings flow and the safe security supply consolidating, which means that this money has to get channelized somewhere else. We think that the appropriate one will be probably the quasi-fiscal balance sheet or some of the corporate bonds through PPP partnerships, which should be able to continue the infra financing in India. Because infra financing wants duration savings because that's the kind of ALM that they want to run, right? Their assets are long duration. The savings also would want to be long duration. And therefore, we think that at some point of time, this savings from the SDLs and GSEC, some of it will start getting channelized towards quasi-fiscal as well as corporate bonds over the medium term.
Okay, but that's extremely positive from a longer-term productivity angle. longer private savings going into infrastructure as well as fiscal consolidation. So very quickly, Shantanu, would you want to take a jab at longer term growth? All these are productivity inducing, higher capex, higher infrastructure, higher savings. Do you think that we are in for a long innings of 7%? What's potential growth?
So our estimates of potential growth in India currently is somewhere in the region of 6 to 6.5%. We think by the end of the decade, you're probably heading towards somewhere in the region of 6.5 to 7%. But one of the key assumptions that we had made was that the key structural reforms, which are difficult to implement, would come through. One being land, two being the farm sector. And in some ways, the farm sector and land reforms go hand in hand. We'll have to see with this coalition government whether we are able to pass these structural reforms. If that comes through, we think that the 7% potential growth on a sustainable basis is very much possible. If not, we think that India's growth rate is somewhere in the region of 6.5 to 7% from what we are seeing.
Okay. All right. We have much to know from even the perhaps portfolio composition, which I think we will get. We just ran pictures of Prime Minister Modi cavalcade going towards for taking over as, reaching South Block to take over. Shantanu, thank you very much. We'll have a better discussion at a later date after we know how things are panning out at the government end. Very important to know portfolios, but we could be in for something strong. Besides, the Reserve Bank Bulletin will also give us the potential growth number. We await that. Wrap up on Bazaar on that note. Chartbusters up next, and then there can be, of course, a lot of news from Delhi as well. Thanks much, but stay tuned.